Okay, you would have all these nesting confluences of implied resistance levels. Once a higher time frame market structure is broken down, then we would be able to position ourselves in sync with a top-down approach with market structure. Okay, and then as price starts to trade down, this is the gray area. All these areas where there's missing gaps, okay, that's intentional. Okay, we don't know what's going to take place between the time where we see an entry point and where we expect to see price get to in terms of our targets, and we'll talk more about that later on. But this is the gray area where you have to be comfortable with, okay, because you don't know what's going to happen from where your entry point and your expected exit point. Okay, you don't know if it's going to go down there. Okay, you don't know if it's going to reverse and take you out of the trade. Okay, but the overall framework, okay, or price structure, okay, this is how market structure is built. Okay, this is a price rally and a decline. Okay, we have consolidation. If we expect to see some kind of a rally in here, something's bullish that we would expect support at, as price starts to rally up, okay, we could be utilizing our mid-level or shorter-term level time frames to see bullishness. Okay, we want to see support being held, resistance being broken. Okay, and every time price starts to pull back and retrace in here, the market structure concept that you would be utilizing would be to simply look for optimal trade entries. Okay, for buys, you would be looking for reflections to buy. You would be looking for type 2 trend following bullish scenarios. So in other words, in all this area here, you'd be looking for price finding support and resistance being broken. Okay, it's that simple. That's the whole framework behind market structure. And as price rallies up into another shorter term or intermediate term resistance level in here, price will hopefully find some support. Okay, but if it does start to break down, be comfortable with price coming back and blowing out previous lows in here. Okay, there may be an important low that's taken place, and trailing stop loss orders would be trailed up below that particular point. Okay, so as price dips back down, all that's going to do is give you another opportunity to get long. Okay, now again, let's think for a moment. This is the higher time frame premise. Okay, this is the highest time frame chart. When we start seeing this consolidation in here and we see the higher level resistance level, because these are all known in advance, this is why we have support and resistance studies done. This is all part of our top-down analysis, seeing where price may be reaching for. So if we start seeing price rally up in here and then consolidate again, and this is another higher level key resistance level, if price continues to maintain support and breaks above all of these short-term highs in here, the market structure implies that we could possibly see a leg from this low, or whatever low would form back here, to this high, duplicated on a retracement here from this low to this high. The same thing could be said with market declines and reversals going along. Every time we see a consolidations, you want to study these for shorter term, more dynamic support and resistance levels. These areas are more easily tradable because they have discernible price levels. They're very clear. We don't know how it's going to take price the next consolidation. We don't know that. We anticipate that gray area that's missing, these little pieces of market structure that's missing. I left that out because I want you to think like this. Okay, if it's a little confusing now, I understand, but if you apply this same general, I don't want to say profile, but this diagram, okay, in other words, in terms of how I have price lows illustrated here, if you look at how price declines actually materialize, you'll start to see these lows form like this, and inside of those consolidations and every swing low that forms, there's going to be a discernible optimal trade entries or reflection patterns, or generally fractal patterns. Okay, so you would apply these concepts, okay, with all the other concepts we've previously discussed, but looking at obviously a higher level key support level down here as a catalyst. Okay, so as price moves from a consolidation down into a new consolidation, much in the same capacity we just saw with the bullish move reaching up into a higher level resistance level, we could be seeing a consolidation in here with this higher level support level down here. This would be where price may be reaching for. So if it's consolidating here, we could look for a move from whatever high forms here to this low, okay, duplicated from this high or whatever high forms in this area down to this low. Okay, so while this diagram is fragmented, okay, think of in terms of the market maker profiles that I just recently shared with you guys this year. You see that same premise here as well. I don't need to draw the lines in here. You can actually probably remember by the way the profile was given to you, you can actually see it in here. Okay, so as price is engineered to go lower down into a support level, ultimately to trade higher, this is the building blocks that we work with. Okay, now because we have to live in the gray area and not expect a simple black and white premise to trading, when we see a consolidation here and price move down to a new area consolidation and price moves down to a new area consolidation, and then we have short-term breaks on market structure. Okay, in other words, we have a shift in market structure right here. As price trades down to that support level, again, this is all assuming this is the highest level of your 3 time frames that you're trading with for your particular trading model. When you see this shift in market structure here, we would anticipate seeing a bullish move higher. But here's where we enter a new level of gray. When we move into this new consolidation in here, this may not always translate into even higher prices going up like we have here implied. It could be just reaching up to go back to this range from this old high to this low. Remember, inside the range concepts. Okay, so you have to have that in mind. So that's why if you're going to be getting long down here, you expect to see some time of profit taking here, right? And you would be able to see that utilizing your mid-level chart, okay, for your swing projections. Okay, and we'll talk about that more as we go on. But generally, as you see price come down in here, every time price retraces and gives you new optimal trade entries, that's what you're looking for. You want to see price holding support, breaking resistance, okay, on this side of the support level being found. But as we're trading down into that support level, we're anticipating market structure to break lows and then find resistance. Break lows, find resistance. Break lows, find resistance. Okay, so every new consolidation, if we're expecting price reaching down to our higher level support level, okay, on our highest level chart, that's why we do our analysis on the highest level, because you want to see where price is probably reaching for. And by seeing where the highest level chart in our particular trading model is reaching for, again, we don't know for certain that they're always going to get there. But if you look in these higher level charts, it's going to give you the highest probability in terms of success. If price doesn't get to these particular points and we start seeing early market shifts in market structure, this could be a catalyst for, another type of trade. Okay, we could possibly get a long in here and maybe even reach up into the range from the high to this low here. That may be a means of profitability. It could be a good reward to risk scenario here. Okay, 3-to-1 could still exist within that framework of price action. Okay, but again, even if that happens, we can still take some short-term trades in here, but that may be a very, very short-term bias, only taking you up to a higher level bias to get lower support levels here taken out. Okay, in other words, you're going to have to blend some concepts here. The inside the range concepts, simply looking at lower lows and lower highs. Okay, if we do get a short-term bounce in here between the high that's formed here and the low here, this could be creating another optimal trade entry to get that fulfillment of this lower level support level down here. Now, again, we've seen this diagram before. Assuming that we have a high up in here reaching into resistance, as price breaks this short-term low here, the market structure is broken. So as price starts to retrace, every time it retraces, we're looking for new selling opportunities. But if we see a previous swing, as we see here, see this price swing here? Okay? If this level's taken out here, if we get a retracement or another additional sell signal, this is where we use swing projections just on price. We're not using Fibonacci. You can, but just looking at simple price action alone, this low to high, once it's broken, you can start taking this same measurable swing from this point here down to that same level and project it lower. Okay, and you get somewhere in this area here. Now I purposely allowed the diagram to be a little bit farther because I teach to exit on the trade before the actual objective is met. Okay, so every time we see a broken swing, okay, this is a swing that's broken here. In other words, this low here, or whatever low it would have formed in here, I'm assuming that you can just see this as a swing. When it's broken right here, we went below it here, if we retrace back into it, okay, I also purposely drew this a little bit past what would be expected as resistance. I've purposely allowed this to move beyond this low here to illustrate how support and resistance can be gray as well. It's not black and white. You're going to have to allow some flexibility with price. So when it starts to pull back deeper, okay, this still could set up the optimal trade entry. Okay, and while this isn't the exact level price was able to stave off a rally, it still was working within the previous range here and this high here as well. So we're still within a bearish market structure. So don't be lulled into thinking this is going to be a long to go higher, assuming again this is a higher level resistance level. And again, every little short-term retracement in here could be a catalyst for an additional entry using our smallest of the 3 time frames. Again, this is all modeling off of the highest time frame, okay, and then assuming once we get this broken down, this swing low here broken, we could utilize the mid-level chart for additional entries and or managing of a position that's already been assumed based on the highest of the 3 time frames. Now as price also breaks down these swings, in other words, this swing up, once it's broken, okay, this is an engineered swing, okay, you see this in price action all the time, okay, it's a measured move, it's very simple, taking this low to this high, whatever that range is, subtract it from that same point here and project it lower, okay, that's the measured swing. Here is a measured leg move. You have the high down to a low here, and when price starts retracing here, we could see this as an intermediate term price swing, okay, or price leg. So we have a measurable swing here that we can use for projections. Then we also have a measurable leg, okay, so we have the first leg of price down here, and we retrace back utilizing the framework that's based on this swing up, okay, so we're blending 2 concepts here, a swing that's broken, okay, and within a bearish market structure. Then we also have a retracement back into a previous support, broken, it should act as resistance, okay, and notice how this low here, I try to more or less imply that price could be reaching for even a shorter term support that's broken now as resistance. So what might look real clear and discernible on the charts, it may not be as clear cut as that, but we would expect this to be an intermediate term retracement for a new leg down, and that's when you would expect to see the high to low here on this leg repeated and projected from this high, whatever forms here. Duplicated from this high or whatever high forms in this area down to this low. Okay, so while this diagram is fragmented, okay, think of in terms of the market maker profiles that I just recently shared with you guys this year. You see that same down here, and that would look similar to what we'd expect when you see intermediate term highs and lows. Intermediate term high is obviously a high that has lower highs on either side of it, okay, and an intermediate term low is a low that has two higher lows on either side of it. So it's very easy to see. It's simply looking at your candles and your bars on your respective time frames, and when you see these, note them, okay, and by noting them you'll have whatever ways you want to have it. I'm delineating and denoting that with these blue circles here. It could be anything on your charts. You could have stars. You could just type intermediate term high, whatever. You could put the little arrows on it. Whatever it is that you use to identify them, that's your way of doing it. But it's important you understand where they're at. And when they start to nest out like this, okay, you can classify intermediate term to now long term, because if we have lower highs on either side of it, okay, this would classify this as a long-term high. That would also allow you to expect to see much longer term price swings, okay. So by nesting out and marking off your swing highs and swing lows on your respective time frames, you start to build a framework that's needed to be able to discern if you're in an intermediate term or short-term price swing and within your market structure. Now that leg that we were talking about earlier can be seen here by having that intermediate term high noted. So this is a intermediate term price leg, and then here's your intermediate term retracement, okay, and then you would see obviously the next leg down would be replicated. So you can see the range between this low to high is exactly what you see here, causing you to expect or anticipate price movement back here. If you're in the trade still, once you've retraced, you can expect to hold on to that trade to get back down to these levels here, which would obviously hopefully be a higher level support level to also converge and have a confluence of reasons to expect to take some profits there. Now, by having all these things in the forefront of your mind and having specific price legs and price swings and how they nest together, it's important you understand that the framework of your market structure is derived from the highest level of the three time frames you're trading with. That's where the framework or the basis of your trade is built upon. Your mid-level chart is used to zero down into a smaller time frame, expecting to find support and resistance levels that may not be discernible in your highest time frame. Then your lowest time frame is used for your entry, and we're going to be talking about that specifically here. Assuming that we've built the premise of market structure and assuming that it's bullish, okay, everything we're talking about here would be obviously reversed for selling scenarios. But assuming we have a bullish market structure, okay, we're a swing trader. Let's say for a moment that our highest time frames suggest that we have a bullish market structure underway. We've traded off of a higher level support level, and price has given us a broken market structure to the upside. Okay, so there's been a market structure shift. Short-term highs have been broken on our highest level time frame chart. Our mid-level time frame has allowed us to zero in and find a key support and resistance level. Now we have this higher level key support and resistance level that's also converging with our mid-level support and resistance level. Okay, and that same support and resistance level may be a confluence of maybe a pattern that overlaps with that specific that level. Okay, and we now have a bias. Okay, this bias is bullish. It does not mean every single day you're going to get a trade that's going to materialize as a bullish move and see profitability. If it was just that simple, guys, everybody would be multimillionaires and we'd all be Warren Buffett's and super rich. So obviously, it's not that easy. You have to have some discernment and allow for some failure, because it's going to happen. But assuming that we have that premise, okay, our bias is to buy. It doesn't mean that traders can't make money going short this specific day or time frame. Okay, it just means that you are going to stick to being a bull at this particular day or particular time frame. Okay, so with that in mind, we always go back to our key premise of trading within kill zones. Okay, so you want to be doing your entries in your kill zone times: London open, New York open, London close, or Asia. Okay, but assuming we have already arrived at our time of day when we're going to be trading, okay, we already understand that the kill zone, when it's going to begin, we already have our key support and resistance level already identified, and we know where price should get to before we do anything, and that's going to be basically this little area right here. So when we're going to be seeing price hopefully at some point move down to that level here, this is our action point. This is where we take action. We do the entry here, and it could be on a limit basis or it could be a market order, but we're utilizing time and price theory. Okay, so this is what it looks like in your mind. There's nothing happening yet. You anticipate these events unfolding within a specific time of day with a specific bias in mind. Okay, you want to see these things line up. And I think what happens is you guys send me emails, you talk about it on the internet, posting on Baby Pips forums. I don't know what the bias is for today. Here's the secret. Every day the bias is both directions. Every day the bias is both directions. Think about that. There's traders making money going long and short that day. But you have to decide on what it is that you're trading based on your time frame and your profile. Okay, as a trader, are you a short-term trader, swing trader, are you a position trader? And you're looking for the bias that you're holding to line up with price action. Okay, you can't force price action to do what you want it to do. You can only get yourself in sync with what price may be doing and allowing you a ride. Okay, so with that assumption, we're looking at price here with the bullish premise that we would be expecting to see higher prices if we get down to this support level. Okay, so we've established that the higher time frame of the 3 time frames we use for market structure study is now bullish. Okay, we assumed that we have a very respectable support level down here. Okay, so if price trades back down to that level within a kill zone, we're going to be taking action here to buy. Okay, and all we simply do at that point is you wait until the kill zone starts, and when price gets to that specific point, you use whatever entry technique or concept you're going to be utilizing for your trade entry. It could be optimal trade entry, it could be reflection, it could be a grail, it could be a stinger, it could be any one of the trading patterns that you're utilizing, but it's happening at a key support resistance level with the higher time frame of the 3 time frames you use for market structure, giving you your bias. So when you have that, this is your action plan. This is what you do. You don't do anything else. Okay, this could be a sell pattern here, okay, for someone that's a very short-term trader, okay, and trades down, and they've made money from this point here to here. That's not your trade. Okay, so don't try to force more out of the concept than it's intended. Okay, you're just simply looking for a bias for your style of trading. Okay, it doesn't mean that you're going to be right all the time. Okay, so take that out of the equation. All you're doing is looking to get yourself in sync with whatever price action is doing based on your premise or your style of trading. Alright, obviously this is a very simple approach to dealing with directional bias, but it's meant to help you avoid the overcomplication that tends to happen with traders. Okay, and it's usually the new traders that try to add all these things to it and squeeze all the tools into giving them a directional bias with the expectation, falsely albeit, that they're going to always know what direction the market's going to move every single day. And I'm going to tell you guys, I've been doing this almost 20 years and I don't get it right every single day. Okay, you know what the secret is to my trading? I simply wait until everything lines up that I'd like to see, where the majority of all my tools, not all of them, the majority of the things that I like to see based on my understanding what markets suggesting to me? In other words, or what profile are we in? Are we overall ripe for a reversal? Are we in a trending condition? Are we in a consolidation area where, I don't want to be taking any kind of trading, with the expectation that we're going to have a trending type of event unfold, because we're going to be working within a large consolidation. I use that as my building blocks, and then by using the market profiling to give me the initial clue as to where we may be trading, then I start looking at actual individual market structure concepts on the 3 time frames that I use for whatever type of trading I'm doing at the time. Because I am dynamic, I move from one time frame or profile trading to another. One week I may be simply a day trader. In other weeks I'll be a short-term trader. And I wish there was a way for me to teach that premise from moving from one dynamic to another. I can't. So it may be disappointing to you, but this is a limitation on me as a mentor. I don't know how to communicate that. But I can give you concepts and approaches to do specific styles of trading, and you just have to wait for the opportunities where price action gives you that sweet spot in terms of being able to apply it. Okay, so by selecting a directional bias, this does not guarantee profitability. It's very important you understand that. Nor does it guarantee accuracy in either your trade direction and or your trade results. One trader's bias may be bullish. Okay, they're looking for buys, and that may exist inside the realm of another trader's sell bias. They both can be correct and make money, and even see both their respective profit objectives achieved. They both can be wrong and make money despite their respective profit objectives not being achieved. Again, it's not being about being quote-unquote correct. It's about being profitable. However, they both could simply lose money and neither trade idea come to fruition. There is no black and white. It's very important you understand that. As a trader, you must enter the gray and be comfortable with the less than perfect visibility. Trades with the foresight that you're expecting don't exist. Nobody has a crystal ball. I don't have it. I'm still trading on the probabilities, not the perfect scenario. There's no perfect scenario, okay? You, as a trader, will see trades materialize that will provide you plenty of profit-taking potential. Live there. Don't expect 100%. It's not going to happen, okay? Because I guarantee you, the only thing 100% is going to happen is you're going to go nuts expecting an impossibility. Find your time frame as a trader. Determine the market structure given for that time frame. Trade within that respective market structure and perform your targeting on the highest and mid-level time frames, and I promise you, you'll have more than enough trades laid at your feet. But it's not about trading every day, and it's not about capturing 1,000 pips a month. Okay, it's about consistently harvesting profits out of the marketplace, keeping risk low, and your action level low. Don't try to trade a whole lot. Keep your trading controlled. That way you're going to control your emotions, your expectations will be kept realistic, and you're going to live comfortably in the gray.
That's not my business. Okay folks, welcome back. This teaching is going to be specifically dealing with the ICT London Open Killzone. Okay, so the London Killzone. What ICT concepts are going to be used in this module? The importance of time and price again. The London Open. The London Session. Important characteristics of London. Okay folks, this is one of those topics where it's a very vast subject, so I'm introducing you slowly into one of the most important time frames of the 24-hour banking cycle. The London Open is typically a time where I like to trade because it gives me a lot of opportunities, and its magnitude is a lot more favorable for a short-term trader. It comes with it a great deal of responsibility in terms of knowing what the higher time frames are doing. A lot of economic calendar releases come out overnight, and they can be very volatile. But the euro dollar and the British pound pairs are ideal for this time of day, and that's why I've elected to trade those two pairs. The London Open frequently sets up an optimal trade entry pattern that can offer 25 to 50 pips for a scalp. The key times to monitor are 2 a.m. to 5 a.m. New York time. So in other words, the easiest way to avoid me confusing you about the time is determine whatever time it is in your area relative to what it is in New York time, okay? And physically wait for 2 a.m. to be in New York, and then calibrate that with your broker and your local time. And always set a clock for New York, and you'll know exactly what I'm referring to in terms of time. It's the easiest way I can overcome that barrier, because it's been a point of confusion many times, because I don't know where you are globally, and you're all in different locations of the globe. I don't know what the translation is going to be in terms of time, so the conversions are going to be up to you. But the ideal ICT London Killzone for your learning is going to be 2 a.m. to 5 a.m. and it's relative to New York time. Now, if you look at this chart here, this is a Eurodollar chart, and what I'm highlighting here is 2 specific trading days, and I want you to take a look at the red. It's like a deep red vertical line. There's 2 of them. Immediately to the right of the leftmost vertical red line, we see price action drop down initially, and then rallies up, and it creates the very high of the day. The day's low forms down here, and it comes off the low and closes off the low. The next trading day, again, here is the vertical red line, and this delineates New York time, midnight. Okay, so midnight in New York, that's what this vertical red line delineates for this particular day, and this represents midnight in New York on this trading day. So we can see that the price rallies again for the Eurodollar up into this small little segment of time, and it creates a high and trades down, creates the low of the day later on, then goes in consolidation and closes in the middle of the range. The key takeaway that I want you to more or less be encouraged to go through your charts and study is that London Open generally has the highest probability of creating the high or the low of the day. So here we see price trading up to, and this little blue line segment and this little blue line segment is just delineating that little pocket of time, that window of opportunity between 2 o'clock in the morning and 5 a.m. New York time. You can see how beautifully it goes up, trades, makes the high of the day, and then trades aggressively lower. Same thing here on this day. It trades up, spikes up, creates the high of the day, and then sells off. Okay, this is one of the biggest things that a lot of students of mine and people that have just casually looked at my things in terms of my tutorials, this is one of the biggest, well, in my career, it was the biggest discovery, because it helps me determine where, when I'm bearish, the actual high of the day is going to form. And if I can do that with a reasonable measure of accuracy or consistency, just imagine if you could get 3 to 4 opportunities where you can get the high or very close to the high of the day and ride the majority of the daily range. If you could do that a few times a month, you could do exceptionally well as an FX trader. Now, it doesn't limit itself to just Forex. This same phenomenon occurs in other assets. Now, I don't trade Bitcoin or cryptocurrencies, but I have students of mine that swear by this working in that asset as well. It works in commodities, it works in bonds, it works in just about everything that trades electronically overnight. Incidentally, you can anticipate things like this to occur in index trading. So if you're trading, for instance, the DAX, the FTSE, or the S&P 500 or Dow or NASDAQ futures contracts, overnight trading, you can see the same phenomenon occur as well. So it really isn't limited to just Forex. Now, because I taught it to the trading community, they assumed that it was limited and only salient to Forex or foreign exchange. I used this same concept as a commodity trader in the early 90s. So it's not that we have an asset class that it can only function in with this type of trading or this type of price action, it's completely universal, and that's pretty powerful. Now, if we have a market that is, let's say, in a strong trending environment, you want to be really focusing in on London, because London will give you the highest probability of a low risk entry price point. Okay, and conversely, we can see when the market is bullish, the tendency is for the market to trade down, creating the low of the day in the London Open ICT Killzone. Again here, market trades down after midnight New York time, creates the low of the day between 2 o'clock and 5 o'clock in the morning New York time. Low of the day forms, off to the races we go. So here's 2 back-to-back trading days. Okay, if you could have taken a long, not even at the low, okay, say you use some of a, I don't know, maybe a buy stop to get in. Okay, if you trail a buy stop above these individual candle highs, and eventually it trips you in, gets you long, and this held on to it for 30, 40 pips each trading day, it adds up quickly, folks. Same thing here. Market creating a low, takes off aggressively. Now, I want you to take a look at the relationship between one London Open low and the immediate day after London Open low. Okay, we have a range that's framed by the low here and this highest high in between the 2 London lows. This is your trading range right here, and this would be an optimal trade entry long using previous days data to today's London setup. So you can get an optimal trade entry on that, and price does an expansion on the upside, and we can see a very nice opportunity to have a long trade on both days here, focusing on London Open, creating the low of the day when the underlying market is poised to go higher. Okay, so the London session itself actually trades a little bit longer than 5 a.m. Okay, but for the sake of my concepts, I want to graduate over time the significance of 5 o'clock in the morning New York time to 7 o'clock in the morning New York time, which is classically like a London lunch period where it can go quiet, it can have minor little retracements, but I don't like to see any type of entry between 5 o'clock and 7 o'clock in the morning New York time, because it can tend to wait for the New York Open, which we'll cover in our next lesson. But the price action during the London session sees the highest probability of a large directional move in the 24-hour day. So what does that mean? If we were to look at the entire 24-hour market and picked a beginning point and followed it around the entire world, and where it began, it'll end. So we have 24 hours of time. If we were to measure the volume, or how much action, if you want to call it any other word, it's layman's terms, the most bang for your buck is going to be in the London Open. Now, that right away draws excitement to younger guys, and if you don't know what you're doing, you can get really hurt quick in the London session, because it can be extremely volatile, and it can be like a lightning bolt. Okay, if you're caught on the wrong side of the marketplace and there's a high impact news event that's out during that time frame, you can get mowed over rather quickly. And if you don't use stop loss orders, that session is going to treat you very cruelly in the form of taking money from you, because London can be extremely one-sided, and once it takes off, it's pretty relentless. It doesn't really give you a chance to get off the hook. Now, the London trading session actually extends beyond the 5 a.m. hour to 7 a.m. New York time. The London session sees the highest volume of order execution than any other trading session. If we look at the little chart to the right, and again, all I'm trying to do is show the profile itself. We don't need to zoom in and look at details of wicks and candle bodies. I just want you to look at it graphically in terms of the way the ranges expand and how it looks overall. So we have trading day here, we have consolidation. It creates a little bit of a run up, rejects that and trades aggressively lower, and then comes off the low and begins the New York session. So we have a micro power 3 formation in here. So we have the open, the rally up, the expansion, the low, off the low it closes. Okay, price is fractal, folks. We can anticipate seeing duplicate patterns that are seen on higher time frames on a lower time frame. So if we understand that the daily range, if it's a bearish market profile or if we're looking for lower prices, the opening on the daily range or daily bar is going to be at or near the high of the day. The high is going to be very limited in terms of how much it goes above the opening price. And then the largest portion of the range is going to be between the open and the close is going to be near the low of the day. Well, this is intraday price action between this vertical line here and this vertical line here. This is delineating 2 o'clock in the morning to 7 o'clock in the morning New York time. Okay, so we're looking at a window of 5 hours. So if we understand that price can be fractal and we're bearish, this could be viewed as a micro power 3 formation. Okay, now why is that significant and why should I be teaching it to you? What's the point of it? Well, if we see in this trading day here, it creates a scenario where, let's assume for a moment that we were anticipating a bullish market move. Okay, maybe this particular day it traded down to a level that was some kind of a support level and we came off of it, traded consolidated, okay, and then we came down initially right after the 2 o'clock time period, and price drops down into a significant low. If price doesn't start to run there during the London session, we could reasonably expect that the real move is going to be in the next trading session, which would be the New York session, which is not going to be our teaching here. It's the next lesson in this series. But you can see the move ensues after the crossover from the London session and then the beginning of the New York session. Now, the London session technically extends even beyond 7 o'clock in the morning up into 10 to 11 o'clock in the morning New York time. Okay, so basically it's 3 o'clock in the morning New York time to 11 a.m. to noon, all relative to New York time. Okay, so there's an overlap of New York and London trading, which makes the next teaching a little bit more interesting as well. But the takeaways I want you to have is that the London session can create the higher low of the day, and we can also study the profile that takes place in between the beginning and ending of the overnight session. If it's trending, okay, if we have a trending model like this, chances are we could see a rather quiet New York session. It doesn't mean that always, but it's one way I like to look for potentially a slow New York session. Or we could have a reversal scenario, which is what we saw here. Okay, to the right of this vertical line is the New York session. You can see it did have a little bit of reversal, but it went consolidated and basically traded in the middle of the overall range and did a close. The very next day, we had an initial drop down in London, creating the low of the day, but it closed the session right in the middle, so it didn't really have much of a trend. It had a spike low, but if we're bullish, it didn't really show any kind of indication that in the London session. But as soon as we crossed over into the New York session and overlap with London, then we have the optimal trade entry, then we have the dynamic imbalance where the range expansion occurs for the daily upside and up close. So London gives us a lot of things to study And I want you to go through your charts and look for examples of the things I just outlined here, and I think you'll be rather surprised. Okay, the London session characteristics. Now, the London session typically creates the low of the day when the market is primarily bullish, and the high of the day when bearish. When the market is poised to trade higher on the daily time frame, we can focus on the London session to post the low of the trading day. If the daily is poised to trade lower, we can focus on the London session to post the high of the trading day. Okay, and what I've done is, instead of putting the Fibonacci on the chart and cluttering it all up, I just basically drew a line indicating the high I'm using and the low I'm using. Now, I'm not using the body-to-body reference points because it's a daily time frame, and I want to encapsulate the entire range with the wicks included. It will not change what I'm going to show you here. So if you have your daily time frame on your euro dollar, you'll see that it will still take us up into optimal trade entry, which is basically a non-indicator form of overbought or oversold. Okay, so what we're seeing here is the market on the euro trading up into the 70.5 level, failing to get to the 79 level, and this candle right here shows a willingness to want to reverse. So the next candle, we could potentially see this be a bearish candle. Now, I'm not looking at swing points, I'm just looking at in terms of where we are in a higher time frame, and this could be a point of interest for a breakdown. Okay, so once we have a bearish candle like this and we're inside the area of optimal trade entry for a sell, or what would be deemed as a potential sell, the very next candle, we want to study that because it may give us a condition that frames a power 3 formation with a down close relative to the daily chart. Okay, so we have this particular day here, which is the 28th of November, and we have the market trading sideways until midnight in New York, and then we have the market initially drop down. We do not worry about that. We want to see it rally up into London Open. It starts this area right here. It's dropping here. We don't want to see that. We want to see price rally up. That's where we'll sell. Notice also that we have equal highs in here. Okay, about 10 pips above this short-term high. That gives us the high of the day. At the same time, we would reasonably expect to see London Open create the high of the day. Why should the daily bias be bearish? Because it's been going bullish here. Well, we traded into an area of optimal trade entry, and we got one candle showing a willingness to reject and go lower. So we want to look for characteristics like we're seeing here. You open and then rally above. We can look to be a seller there after it takes equal highs out. So we have Candyland, buy stop liquidity pool. Okay, runs up, knocks the stops out, and then trades aggressively lower. Creates the low of the day. It comes off the low of the day and trades at or near the low. So in relationship to power 3, if we're looking at this price action here, you can see that would be the daily range. So we can see that the opening, it's a very limited upside movement above the opening. That's this little portion of price action here. It creates the high of the day during the London Open Killzone between 2 o'clock and 5 o'clock in the morning. Dynamic imbalance or range expansion for the daily candle or bar, creating the low of the day right here. Then we come off the low, trading near the low of the day and closing right here. So this is this whole candle right here. This is what it looks like in a open, high, low, close format. So hopefully you found this teaching insightful. And until next time, I wish you good luck and good trading. Okay, folks, welcome back. this teaching will be dealing specifically with the ICT New York Killzone. Okay, the New York Killzone. What ICT concepts are going to be used in this module? Again, the importance of time and price, the New York Open, the New York Session, and important characteristics of the New York Session. Okay, the New York Open. Now, the majors that are coupled with the dollar index, or the dollar, that to me is the ideal pair for this time of day. The New York Open frequently sets up an optimal trade entry pattern that can offer 20 to 30 pips as a scalp. Now, the key times to monitor are 7 a.m. to 9 a.m. New York time. This is what I refer to as the classic ICT New York Open Killzone. Every single day, Monday through Friday, I believe that if a trader were to scan through the majors that are coupled with the dollar index, they would find a setup that would offer 20 to 30 pips. I teach that as a means of inspiring study, but not to encourage you to try to trade every single trading day. Every day, there is an opportunity for you to study, but that does not mean to go in and try to trade with live funds every single trading day. So by having that expectation that 20 to 30 pips exists every single day, Monday through Friday, that's, again, not an inspiration for you to go in and expect the 100 pips to 150 pips a week. I look for, my personal trading is 50 to 75 pips a week. So between what I've shared so far with the London Open, with the Asian Open, and now with the New York Open, you have 3 opportunities every single trading day to look for an opportunity to get those specific objectives for the week. So I know that there's a high probability that I can get my entire weekly objective in one solid London Open if it moves a lot. If I do not get it, or I do not get a weekly objective, which is my one shot, one kill, where I trade the weekly range, because that's really what I'm framing my setups on. But if I miss it, or if I get it wrong and I have to mitigate a loss, I will use New York to mitigate any mess ups that I make during the week. My focus is at the beginning of the week, because Monday, Tuesday, and Wednesday, if I operate most of my trading, many times all of my trading is then, but if I take a loss or if I miss an opportunity and I still feel confident about the weekly objectives still coming to fruition, that means I see a setup that's still viable. I will go in and trade the New York Open to get those small little scalps to add up to 50 to 75 pips. So I'm confident that I can get 20 to 30 pips in a New York Open in one of the majors every single day. That's my experience speaking. It's not an invitation, again, for you to go in doing it. What I'm trying to encourage you to do is go through the charts and see if what I'm saying isn't exactly what you see. Every single dollar-based cross will give you a setup between 7 a.m. and 9 a.m. New York time. It's the easiest time to trade because we have the luxury of having London overlap and New York. And looking at the chart on the right, this is a Aussie dollar pair, and we can see that right in here, I'm delineating the New York Open here. That sets up the opportunity, and the optimal trade entry is seen here. London low, initial daily high, the retracement, and then a subsequent expansion, creating the high of the day. Everything framed relative to what is seen on the London low for the buy. Wait for the retracement between 7 o'clock and 9 o'clock in the morning and rally. Now there's a lot of things that goes along with making this setup identifiable. Obviously it's very easy for me to point to these in hindsight, but experience has taught me how to see these things by a small sample size of conditions. Okay, not all of those conditions are going to be taught to you in my free tutorials, so you're welcome to join the mentorship. You get all the details that are not there, but you will get a lot of insights just from the free tutorials. For now, I want you to just be content with identifying between 7 o'clock and 9 o'clock in the morning, Monday through Friday, when the dollar crosses. In other words, every pair that's crossed with the dollar, if you watch those pairs between 7 o'clock and 9 o'clock in the morning, and if you have a job or if you have a business and you can't trade this particular time of day, even if you look at it in hindsight in the evening after the market has closed, you'll be able to see many examples that repeat themselves every single trading day. But again, every pair doesn't have a setup every New York Open, but every New York Open has a setup in one or more of the majors that are crossed with the dollar. Now, everything I say is reversible, if you will, and we can see the same scenario for the euro dollar. We have an opportunity to see both sessions here. The Asian session creates a swing high, the London Open creating a high to sell short from, and then the New York Open retracement creating a high, and it expands and goes lower. This particular pair and this day, I actually traded this, and the examples are shown on my Twitter, and you can find that for your own study. But for now, just understand that between 7 o'clock in the morning and 9 o'clock in the morning New York time, there's typically a setup that forms that offers 20 to 30 pips. Okay, the New York session. The price action during the New York session sees a consistent round of economic news releases. Now, these news releases will many times stimulate price action, and sometimes it's predictable, and other times it's not. Sometimes these news releases will cause reversals in the marketplace, and sometimes they'll add fuel to the fire and or momentum to an existing daily bias. The New York trading session actually extends beyond the 9 o'clock hour, and it goes to 2 p.m. in New York time. If you look at the chart here on this dollar CAD, what I'm delineating here is those specific time points when the New York Open begins and 2 p.m. in New York. Again, as I shown in the previous session or kill zones, everything is fractal. So if we see the open here and we're bullish, we see it open, a small little decline, creating the low of the range, expansion, high of the range, and then comes off the high and closes. Just like in Power 3 on the daily candle or bar, we can see the New York session creates that same fractal pattern. Again, same scenario here. You see an open, it trades down, creating the low of the range, expands up, creates the high of the range, and comes off the high and closes. Power 3 applied to the individual trading sessions. Now again, there's a lot of things that goes behind the scenes, if you will, that builds these models or expectations for when price should be doing it. The clear and obvious one that I'm going to show you in my free teachings is we have a previous low, it rallies, it trades back down into a retracement for an optimal trade entry between this low to this low. Okay, so we can see using previous day's lows to the session low for New York, we can get an opportunity to be long with this scenario. The New York session characteristics. The New York session typically has two potential scenarios: continuation of London's move or a complete reversal on the daily direction. Now, it's not my goal to teach you market reversals because, quite honestly, there's a lot of things that are required to do that. But there's some things in the tutorials that will help you, but it's not going to be complete science because it takes a lot of information and a lot of teachings to supplement those conditions, and even then it's not going to be clear to you. Experience is going to be the teacher, if you will. But the continuation of the London move, I believe, is the easiest, and that's why I taught in my free tutorials that approach. So when the daily chart is in a clear one-sided momentum, it is easiest to look for the confirmation of that direction in London price action. For example, if London agrees with the daily chart being bullish, that means we should be seeing a low form in London. We would anticipate a retracement lower in the New York Open and in agreement with that daily bias. So we would anticipate a New York low to post a continuation setup or optimal trade entry buy. Again, reversals they require a lot more things that I can't teach in just one video. There's so many things that goes into that, and if you go through, access my old teachings, my old free tutorials, there's a lot of emphasis focusing on higher time frame. Now, there are times as a well-experienced trader that's been doing it a long time, like myself, I can trade any time frame, and I can also look for reversals that would go contrary to the higher time frame direction. You as a developing trader may not have that diversity yet, but you will have that over time. Experience is the teacher in that. Now, I give a lot of details about that in the mentorship, but you don't have to have that. Okay, you don't need that. If you get accustomed to trading continuations and trading in agreement with the daily bias and only taking those setups, you will have the best setups. Because sometimes the reversal patterns, sometimes they're great and they pay out a lot and there's big movements and pips. Other times it's not so much and they can be rather disappointing. So it's much easier for us to see the daily bias on the daily chart where that momentum is and trade in that direction, because that's going to be the most likely expansion or the most likely side of the marketplace to be on where the big moves are going to occur. Again, there's going to be shocks and retracements all the time that come in the marketplace that are either expected or unexpected in the form of reversals, okay, or deep retracements. They're not necessary. They're very exciting sometimes, real quick, one day or intraday declines or rallies to retrace to another optimal trade entry sell, something like that. Try to convince yourself that it's much easier to trade with the daily bias and to look for your daily ranges to expand in that direction. You're going to see folks online that are going to be showing a lot of trades they may not have taken. They may not actually have any any horse in the race, if you will. It's just them talking about something that's already happened. Try to just keep your focus on looking for scenarios in the New York Open that are in agreement with the daily. So if the daily's bullish, we're looking for London to create a low, and then at 7 o'clock in the morning, we're going to be looking for some measure of a retracement lower. And then we'll be seeing, or anticipating rather, a optimal trade entry to go long at the New York Open, and anticipate expansion on the upside on the daily range, where we would expect that range expansion for power 3 for the daily bar or daily candle. That's what we're looking for, that dynamic imbalance. Okay, I have an example of that here on the dollar CAD. We have a London low form, and we can see that the market did in fact come back from this low to this high. It retraced rather deeply here. Optimal trade entry long here. Then price rallies away, and then we have a retracement lower in the New York Open. And several things in here. There's an optimal trade entry, and there's also a run on liquidity. We have equal lows in here. In a bullish market, the market comes down into New York Open, takes those stops out, and then rallies. So that would be one scenario we can look at here. And the continuation of the daily range on the upside, and reaching for relative equal highs. The liquidity pool resting above those highs, you see it reaches for that rather handsomely. Okay, so New York Open, in my opinion, and I've been doing this for a very, very long time, it's so much easier to trade that session because it has a built-in advantage. And the secret to it is what's going on in London. Okay, if you can arrive at a daily bias on the daily chart and then wait to see if London supports that notion. If it's bullish and London creates a low and we've rallied and then we start declining into New York Open, it's pretty much a loaded deal. You're going to have a scalp that would offer 20 to 30 pips in New York. And if you're new, you're probably not going to appreciate that too much. But if you have been trading for a while and you just heard me explain that, you're going to be rather surprised and tickled when you see how often that unfolds, because you have a little bit more experience in reading price, and it's going to jump off the chart at you. And then suddenly you're going to see a lot of opportunities that otherwise went right over your head. So hopefully you found this teaching insightful. If you enjoyed it, you can find more at theinnercircletrader.com. Okay folks, welcome back. This teaching is going to be specifically dealing with the ICT London Close Killzone. Okay, London Close Killzone. What ICT concepts are going to be used in this module? The importance of time and price, the London Close Killzone, characteristics of the London Close. Okay, so the London Close is a particular time of day that usually ends the opposite end of the daily range. The major pairs, usually coupled with a dollar, are ideal for this time of day, and the London Close frequently sets up an optimal trade entry pattern that can offer 10 to 20 pips for a scalp. The key times to monitor are 10 a.m. to noon New York time. This is the ICT London Close Killzone. As you can see here on the chart on the right, this is a dollar CAD chart. You can see the beginning of the day, we had consolidation, but in that consolidation during the Asian market, we create the low of the day. Then after midnight New York time, the market rallies one-sided all the way up into the time window that's delineated between 10 a.m. and noon New York time. This is the London Close Killzone. You see the daily high formed exactly within that little window of time, and then price subsequently traded lower into the close. Another example here, this is the euro dollar, just to show you how the London Close encapsulates the daily range. Okay, we have the Asian range in here. The high created during the Asian market. I actually traded this pair. Again, this is a very similar chart we've used in this series so far. But the high forms in Asia. Then after New York midnight time, we had a high form again in London high, New York session high, and then the low of the day forms exactly at the parameters between 10 a.m. and noon New York time. This is the ICT London Close Killzone. Market trades higher off that window of time and then goes into the close. The London Close Killzone, if we study this portion of the day, the price action seen at London Close typically sees a retracement off the high of the day on bullish days and off the low on the day that is seen bearish. There's typically a 5-minute optimal trade entry set up in these conditions, but they're very important to remember this. They're very, very short-term in nature. So the moves aren't a lot. They're not like the equivalent of like a London Open or a New York Open. It's typically going to be very small, short-term, 10, 15, maybe even 20 pips. If you get anything more than 20 pips, it's going to be a rarity for that to occur. But you can see as an example here, the Aussie dollar, we have the ICT London Close Killzone in here, and the market creates the low of the day, as we would expect. Then it gives us an optimal trade entry long and trades higher. Now this gives us a rather easy 20 pips in here. On this particular day, they won't always look like this, but it's important to see how the daily range is encapsulated. The higher lows generally formed between 10 o'clock and noon New York time. So for the sake of note-taking and completeness, if we're bullish and the daily close is going to be high relative to its opening, in other words, it's an up-close day, the London close is going to be typically when the high of the day is formed, between 10 o'clock and noon. Now, there will be times when that isn't the case, but for now, if you use this general rule of thumb, it's going to serve you well. Okay, characteristics of London close. Now, the London close can create continuation points for swings that trade well into New York afternoon hours. That means if we're bullish overall in the day, instead of creating the high of the day in bullish markets or bullish days, many times the London close can actually create a continuation pattern, as seen in this example here on the dollar-yen. The market had traded higher initially during the day, and then we had a consolidation, but inside the consolidation we had an optimal trade entry here. This is going to be on a 5-minute basis. Okay, whenever we're studying London close, you have to be looking at it from a 5-minute. Anything higher than that, you're not going to get the detail you need. But optimal trade entry long in here, it creates the continuation of the overall trend and a nice extrapolated move all the way up to the 300 extension. And what had been the direction of the day or week can change during the London close. And let's take a look at the example here. And you can see in this Aussie dollar chart, we can see that very phenomenon take place. Let's zoom in and take a closer look at what's being shown here. This is a New York and London close overlap. So there's characteristics that's important for New York session. Typically what you'll see is the continuation of what's seen in London overnight. And that would be, if we're bullish in London, we would expect to see New York continue moving bullishly as well. And then London close be the high of the day. If we're bearish and we've seen London bearish, then New York bearish, we're going to be looking for London close to be the low of the day. Okay, between 10 o'clock and noon, we'll expect to see the low of the day form. Now, if there are times when the market creates for instance, a liquidity pool like this, you can clearly see what I'm going to reference here, but it's the double top right in here. And we can see how London close this particular day creates the high of the day, but also forms a reversal point for the rest of that day. And the next day we see price move rather aggressively lower. So if we look at all these characteristics as a whole, okay, I've started with the intraday, even though some of you may not be interested in day trading because of your life circumstances or you just don't have an appetite for doing it. It's beneficial to understand the engineering of how price moves from the short term, and then we can work from that price point higher into the higher time frames. It's important to know these things for entries. It's important to know these things for managing positions, because the characteristics that have been shown in the free tutorials that I've done thus far, they may seem rather simplistic. They may be rather short in duration. You're used to very long videos from me, but the insights I've given you are very concise. They're very generic, but don't let that simplicity and short-term delivery and presentation fool you. There's a lot of insight that's been shown. I've given you the DNA, if you will, of how a daily bar or candle is formed on bullish and bearish days. The times you're going to be unfruitful using this information is when we have a Z day, where it goes up and down in quiet consolidation, or a seek and destroy day, which is a really wild, choppy up and down day where it doesn't really go anywhere until the last portion of the day, and then it runs out the stops and no one saw coming. So if you accept the fact that you're going to have days where you're going to see a scenario that may form, and you may believe it's a scenario that may warrant a entry on your demo account, it may not come to fruition. If you study the things I've given you thus far, we went through the Asian session, the London session, the New York session, and now we've completed the daily range with the London close Killzone. So we have everything at our disposal in terms of defining the daily range. Now, that does not mean daily bias. It does not mean long-term direction. It just means that we have been able to define
the 4 reference points that make up Power 3: the open, the high, the low, and the close. And what those 3 phenomena take place inside of those 4 price points, which is the accumulation, manipulation, and distribution. So hopefully you found this teaching insightful. You can find more at theinnercircletrader.com.
Okay, folks, welcome back. This teaching is going to be specifically dealing with the weekly bias, excellence in short-term trading. Okay, the weekly bias and short-term trading. Points of focus in this module will be mapping bullish weekly profiles, when to anticipate weekly lows to form, and mapping bearish weekly profiles, when to anticipate weekly highs to form. Okay, so the weekly smart money view. As you can see here, this is a chart depicting 1 week's worth of trading. And I want you to take a look at how the market gyrates from day to day, Monday, Tuesday, Wednesday, Thursday, and Friday. And this would be in a bullish scenario. Okay, this is for bullish conditions. What we're looking for is the weekly low to form between Sunday's opening and Wednesday. There are high odds for the weekly low to form before Wednesday's New York Open, or what would be otherwise 7 a.m. New York time. The odds further increase between Tuesday and Wednesday, focusing on Tuesday's London to Wednesday's New York Open. So let's flesh out some more ideas about this. What you're going to be looking for is a higher time frame directional bias, and there's a couple different ways you can do that, and I teach those in the mentorship. But if you like looking at higher time frame charts like monthly and weekly charts, they will aid you and assist you in determining that. But this is a hourly and or 30-minute time frame viewing the weekly perspective, so that way you can see the entire daily range over the spectrum of the entire Sunday's open to Friday's close. What we want to be focusing on is the opening price on Sunday. Now, some of you may not have a Sunday candle in your platform, and that's fine. It's still beneficial for you to seek out whatever the Sunday opening price is. So you can use things like websites that follow the foreign exchange markets and get an opening price, because sometimes those opening prices will create gaps from Friday's close. Those gaps are very indicative of sentiment, and sometimes they could be exhaustive, or they could be insightful in the form that it's showing underlying strength. If it gaps up, it may not fill. It may not trade back down and fill that gap and then trade higher. It may just straight away, go north right from the higher opening on Sunday's open. What we're looking for is on Sunday's opening, we want to see that opening price and extend it all the way to Friday, keeping that in mind. And I'll explain why that's important in a couple minutes. But what we're primarily looking for is a power of 3 formation on the weekly range. But from a 30-minute chart, which is what we're showing here, this is going to give us the intraday reference points, and it'll show you how the market moves and gyrates with this in. Now, if you choose not to use Sunday's data, which I think is a little myopic when we're at least talking about the relationships of the opening price for the weekly range, because you have to understand that still is there in terms of trading. Just because your platform may or may not have a Sunday's candle, the market did in fact open many times hours before you would expect it to have shown price on your Monday candle. So it's beneficial for you to go through and research and find out what the opening price is on your respective Forex pair. That's what you're using. You can elect to go with the opening price on Monday's trading, but your data is going to be slightly skewed Okay, so whatever your first opening price is on Monday, you can use that price and draw that across. Okay, but if it's an instance where the market starts at a lower price level on Sunday, we may not get the opportunity on Monday's opening price to dip down below it when we're bullish or wanting to be a buyer at the opening price or below it. Okay, so I use the Sunday's opening price to teach new traders because it teaches them, number one, sentiment. It teaches them overbought, oversold without the use of indicators. Okay, and it also teaches you to trust the higher time frame premise. What's the monthly and the weekly charts suggesting? Are they implying that we're going to be moving higher, or are we moving lower? This example here is going to be framed on the basis that we elected, by a way of analysis, that the higher time frame charts are looking for higher prices. So that means price is going to expand on the open on Sunday or shortly thereafter, and having a higher close, or at least expanding throughout the week to make a higher price level where we can hopefully find an opportunity to harvest some pips. In terms of Power 3, what we're seeing here is the relationship day by day and what price has done with that opening price. But in terms of a weekly range, if you're a short-term trader, you can use this insight and not have to worry about day trading at all. Once you know the opening price, you're going to be anticipating that move down below the opening price. Now, what level you choose to buy it down there, there's lots of different ways you can do it, and I teach a lot of them. And it's not important for me to share with you any one particular setup, because I've learned over the years teaching that some of my concepts don't always gel or more or less work for certain individuals. It's not because the patterns or they're not favorable in terms of how to use them in the price action. It's because of personality. I'll give you an example. To be a buyer when the market creates a new low, that is sometimes scary for certain traders, and they won't want to do that. Other traders that see that and they say, well, it makes perfect sense, they will gravitate towards that type of pattern. The ones that don't want to be buying below old lows, that trader will probably do very well when they do optimal trade entry buys, where it's proven it's gone up a little bit and then it retraces. It makes more sense for them to do that. So that's why in the free content, I'm avoiding that whole way of teaching, because it gives the impression to the students or the first-time readers or viewers of my content that I'm trying to promote you to follow a specific mold, okay, or press you into a specific mold, which as a teacher and a trader, I know that doesn't work. It can't work, okay? It might work for some of you, but I don't want to make my success as a mentor be based on just a handful of my students. I have a way of teaching where the content is there for you to plug and play for your own personality. And I do a lot of that stuff in the mentorship, but for free content, this is all you need to work with, and you'll find all the setups you'll ever look for. Now we can fine tune this principle and actually give you specific levels on which you would be buying at below the opening price, both in a day trader's perspective and or a short-term trader. So as a short-term trader, if you've watched my content and you've been, well, impressed with the ability to have that precise of an understanding, you can still use these same concepts by way of using the opening price and trading the weekly candle. So the weekly range or weekly candle, they're synonymous terms, okay, but I use them interchangeably. But for the sake of weekly range, that's exactly what I'm talking about. Okay, so what we're forming here is this particular week's entire data from the low of the week to the high of the week. This opening price is representative of the Sunday's opening price. We would be already bullish on the week. We would anticipate this movement from the open and down. We would not be interested in anything from the open to trade up first. We would look at that as not interesting. We would wait for it to drop down into an oversold condition. What makes it oversold? Because its opening price is value. Okay, that's fair value at the time of new trading. At some point in the future, we would anticipate the market dropping down. Okay, that drop down from the opening price is going to make price in terms of overbought, oversold, because the context or premise behind it, we would already be bullish relative to the monthly and weekly chart. So if we're expecting the weekly chart to continue higher, the new week, we would expect to see the opening price, the drop down, which is a Judas swing. This engineered move is to knock individuals that are already out long, or drive individuals that are not in the marketplace that want to sell short to entice them to do so. Any pending orders that would sell in a breakout, they would be filled down on this movement here. So you, as a short-term trader, you could elect to buy at one of these levels below the opening price that my tutorials teach some of, but we go into great detail with that in the mentorship. So you can frame all types of entry techniques and concepts. They reside below the opening price, okay? The way we use this information from the free tutorial standpoint is if we know that the low of the week from the opening price on Sunday, making the low of the week on this weekly range, it's going to form between Sunday's opening and Wednesday's New York open. The odds favor a greater chance of the low forming when you're bullish between the London setup and the New York setup of Wednesday. So Tuesday's London setup to Wednesday's New York setup. Between those two time periods, I'm going to encourage you to go through your charts. It's really, really easy to go through hindsight data, and you'll see what I just told you is like the elephant in the room. Retail traders, until I taught this stuff publicly on my YouTube channel and in my tutorials, nobody was talking about this. Nobody was mentioning it. No one was using it. And the folks that tried to say they were always aware of it, they showed examples in their trades and it never was there. They were doing the things that were opposite to what this teaching teaches. I've been doing this for 2 decades, okay? And only a few handful of individuals around the world had opportunity to learn from me, good grief, about 18 years ago or so. And that small little circle of individuals, they and myself have the only ones that have really been aware of this type of phenomenon. Now, since I made my tutorials, there's been educators and such, they've linked on to what I teach and they rename it. Okay, they call it a weekly strategy. They call it, whatever else they want to come up with, and they add some kind of a twist in the title. But once you see what they're doing, it's what I've taught here and what I've taught in my previous teaching, how to capture explosive price moves, which is a free tutorial, which I didn't like the presentation, but if you watch that video or look at it, the first couple minutes of that video is actually what I'm showing you here. So once that was produced and shared on Baby Pips and that crowd watched it all there too, it caught fire. Problem is most traders, they don't know what to do with it below the opening price when we're bullish. So which level do you buy? In this instance, I'm just going to teach the classic market structure, bullish optimal trade entry. Okay, so you're going to anticipate Tuesday to Wednesday's low forming. Now, sometimes it's going to form on Monday, but you can still get a continuation move on Tuesday or Wednesday. But primarily, I want you to be thinking how Tuesday to Wednesday in that time period, that's when the weekly low is going to form. Many times, it's going to be Tuesday's London open. Okay, now, if that's going over your head, I want you to stop and think about what I just told you. The weekly low most likely forms on Tuesday's London open when we're bullish. If we are bullish and it does not form on Tuesday and we drop down on Wednesday, Wednesday will probably be the low of the week. If we go lower than the low formed on Wednesday's New York open, you have to nix the trade and go to the sidelines on the day, especially if you took an opportunity on Tuesday or Wednesday and they were losing trades. You have to stop and just submit to the fact that you were wrong, even if Thursday or Friday it goes higher. And that's a very hard lesson to learn because you were bullish on the week, but you get stopped out and it still ends up going there and you missed out on it. That's going to happen. It's happened to me many, many times, and it does not undo the effectiveness or the validity behind the setup. There's going to be an imperfection in your trading, so you have to permit that, okay? But if we're looking for the low to form on Tuesday or Wednesday, what we're simply looking for is a new low on the week, preferably on Tuesday's London open or Wednesday's New York open. okay, between these two reference points. Should that occur, okay, as soon as we have a lower low in the week formed, we find the short-term high prior to that new low forming. In this case, it's this here, okay? So when that occurs, that's our trigger point. So for individuals that want to buy on retracements with optimal trade entry, we're going to wait for price to break above this short-term high, which it does here. From this point here, you're going to be looking for the low to form prior to this run up. Now, classic fib people will go from this low to this high. Sometimes that'll work, sometimes it won't. What I want you to look at is we have the most dynamic price movement off of this low. So you're going to anchor your fib on the lowest close or open in that swing low. Drag it all the way up to this body here. Now, I don't have that in here because I want the presentations to be clean, because my watermark on top of the chart and my references that I'm showing you here. I want you to go through and look at this for yourself. Go through your own data. The November 21st and 22nd of 2017. Use a 30-minute chart, and you'll be able to see pulling that fib from that low to this high. You get an optimal trade entry beautifully lined up right there. And there's your continuation buy. And here's the thing. You're buying it below the weekly open on Sunday. You're buying below that weekly open, trying to do power 3 on the week. This gives us the best advantage, okay, to be in before the expansion that takes place on the weekly range, because we're buying below a valuation that would deemed as fair, and then it drops down to an oversold condition. So while everyone else would look at these movements dropping down here and dropping down here as momentum on the downside, our perspective is like of the smart money. We're looking at that as it going down to an area of a really, really cheap price. So if you're terribly afraid to step in there right when it breaks below to a new low, I understand that, but over time you're going to have to encounter that and just move past it, or just elect to go with optimal trade entry as your pattern. And there's certainly nothing wrong with it, but if you're wanting to buy up here and you're always going to wrestle with the idea, I wish I would have bought down there, this is only going to occur if you buy at new lows at a time when it should be creating the low of the week. And like I said, it's hard to do that without just getting in there and desensitizing yourself by practicing in a demo account and doing it live with a demo over and over and over again, to the point where you just don't care if the outcome is going to be profitable or not, because that's what it takes to be consistent. You're not worrying about the end result. You just trust the process of what you're doing. Eventually, over time, the sample sizes are more weighted on the positive side of what you're expecting to see than that of the temporary and sometimes, unwanted negative results. That is missing the trade or getting stopped out. So this would be the optimal trade entry here. And again, it's on a day that we would look for it to form on Wednesday. And price starts to expand. We get about above the opening price. Preferably, we want to see price show a willingness to want to expand away from that opening price and not want to come back down to it. Now, there are some certain caveats to this, and I'll add this to you just to give you a little bit more spice on this. If we make the low of the week on Monday, how do we know that? It trades back above the opening price, okay, on Monday, and expands a little bit more, okay? This right here, we dropped down, we went back above the opening price. I don't trust this because it's Monday, and I like to see the Monday's range, okay? I want to see what the Monday's entire daily range is. So I don't get the weekly lows many times. Actually, let's just be fair about it, about 98% of the time, if the week makes its low on Monday, I'm missing that because I elect to sit many times on the sidelines because I want to use the range of Monday to give me insights. So on Tuesday, I like to get hopefully a lower low when I'm bullish, and then I'll buy in here, okay, based on some pattern or some kind of a key level I teach. And then I'll ride that out and hopefully get back above the opening price. Now, if we trade above the opening price on, say, Tuesday, I will permit Wednesday to see retracement back down to the opening price, find some support, and then rally back away. On Wednesday, If we're breaking above the opening price on Wednesday, it cannot and it should not come back to opening price. Now, again, in simple terms, Wednesday is the line in the sand. If it trades above the opening price when we're bullish, we do not permit it to come back down to the opening price. It can happen if we go above the opening price on a new low on Tuesday. We can still see it come back down and retest that opening price on Wednesday. The algorithm will want to expand away from this opening price after Wednesday because it only has New York opens time period to Friday's close. And that's why you see this acceleration in the movement on the weekly range immediately after Wednesday breaks above the opening price. Now, you're going to look at this, and I'm going to be criticized by folks that don't like what I'm teaching because they're sold on indicators or whatever else they're doing, or they don't like the fact that I'm right. They're going to say this is being cherry picked in a hindsight capacity. Well, granted, I am hand picking this in hindsight to show you because it's already happened. Anyone teaching you anything is going to be some level of hindsight. I'm telling you to go through your charts and you will see this yourself. As many as examples as you're going to find, you're going to see quickly what I'm telling you is the gospel. Okay, it's just the way it is. You can argue and wrestle with this, but if you trade against this premise, you're going to understand why you're losing money. Okay, so once we get through the opening price on Wednesday or on Tuesday or Monday, I personally will never get the low on Monday of the weekly low. I won't get that on Monday. You can try to test that theory and buy down here, and you might get something like this, and this could have kept on going. If you're going to trade on Monday, if it trades back to the opening price, my opinion is to take some profits there and leave a stop in, so that way if it does knock you out, it protects any open profits, but leave it in there because you might have caught the tiger by the tail. Statistically studying all the possible scenarios and weekly profiles that I teach, I elected to simply wait till Tuesday. And that's just the way I do it. Obviously, I'm not encouraging you to follow me step by step, but I'm doing it and telling you this because I want to be open about how I do it. Tuesday, I'm really actively looking at London Open. Okay, that's really what I'm looking for. So between London Open on Tuesday and Sunday's opening, I'm really not doing much at all. I'm just relaxing and spending family time. I'll glance at the charts, but I'm not really trying to actively pursue anything until around London Open on Tuesday. And if you look at the weekly ranges on the foreign currency pairs, you'll see that many times when we are indeed bullish or bearish, these turning points will form on Tuesday's London Open. But for this example here, we're bullish and we're looking at the opening price on Sunday. We want to see it drop down. It trades down to a level. We wait for it to break a swing high. Okay, and this could have easily formed on Monday. And the retracement could have been occurring on Tuesday like it is here on Wednesday. And then Tuesday could have traded to the opening price. And we could still permit it to come back down to that Wednesday retest of the weekly open. But after that, it's not allowed to do it again. If it ever starts to gravitate back down to that opening price after Wednesday, trading through it, it's probably made a reversal or it's going to consolidate for the rest of the week. Either one's not good for a weekly expansion. Now, there's going to be times where we'll trade above the opening price on the weekly range and not go very far and just gravitate right back to the opening price. And it's going to be a quiet, mixed week. If it's still bullish the following week, we would still use the same criteria. Okay. But the next stage would be we would be expecting that expansion here. Now, this portion of the weekly range is going to be what you're holding for, and eventually until Friday's close. Your mindset should be not trying to find 10 pips or give me 20 pips, okay? I start my week off looking for scenarios that get me in down below the opening price because I understand that below that opening price is the ideal entry point for all my day trades and my short-term trading. As a short-term to swing trader, you can use that insight using the weekly ranges and not require yourself to be anywhere near an hourly or 4-hour chart or anything less than that. So there's no reason